Stocks are shrugging off the job surprise, and my next guest says that could be because investors have found enough weakness under the hood. Let's talk markets with Julie Biel. She's chief market strategist and portfolio manager at Kayne Anderson. Julie, with apologies for the delay, listen, can you explain to us why stocks are at all-time highs after this report?
Well, I think investors are still confident that we're going to be seeing rate cuts this year, and that's really all they need in order to go forward. My concern, however, is that we are at a relatively high level of interest rates, and so getting excited about 25 basis points, 50 basis points this year is a little bit like clamoring in to get into a nightclub, and getting there and there's no one there. Like, the pretty girls show up later. You're going to have to wait for these rate cuts to really make a positive impact on the economy. No one who owns a house with a 3% mortgage is going to be that excited about a 50 basis point rate cut in the next 6 months. So I think we're probably good 200 basis points from the neutral rate. And so a lot can happen between now and then. And that's what I think investors need to be thinking about.
That's the line of the day. And it was a high bar. The pretty girls show up later. So where are you guys then on the market? Do you think that what do you practically think that means?
So what I think is kind of interesting is that if you look at the market, the ratio of cyclicals to defensive, cyclicals have been well outperforming. And that makes sense because margins have generally been quite healthy, quite strong. My concern is that if there's any kind of weakness, if consumer spending pulls back, if pricing can't be held, you're going to see a rush for the exits. So for us as investors, I think we really try to focus on the quality businesses that have more market control, that can weather that kind of change, and that won't be as impacted if there is a major PE revision that we would see going forward.
Right. But in other words, you think right now it's just what they were saying last segment, that they want an ECB-like outcome here, basically kind of a hawkish rate cut. And what you're saying is, don't assume that means the economy won't have this kind of melting point that Powell might be worried about, the nonlinearity that others, that it can happen. So you're still kind of worried about that.
Yeah, I think I still have concerns because, the pockets of the economy that are doing really well, they are, quite substantial, right? We know that what's happening with AI and hyperscalers has been just really substantial earnings growth, but that's not consistent across the economy. We know we have a consumer that has spent down all of their savings that they accrued during the COVID pandemic. And so we don't have as much margin or cushion as we typically do, right? We can only spend so much as consumers, and the government, we also know, has worn down their cushion. So my concern is that there's just not that much slack to withstand any kind of economic shocks.
All right. I love the stocks. You always have, Simpson Manufacturing, SSD, Advanced Drainage, WMS. People could do their own homework. But Julie, we appreciate your analysis on this fine day. Thanks for joining us.